Welcome to the Growth Cap Podcast, where we chat with CEOs, investors, and other key industry leaders to uncover insights and strategies for succeeding in business. I'm your host, RJ Lumba, Managing Partner of Growth Cap. In this episode, we chat with Ben Weinberg and Josh Elzer of Susquehanna Growth Equity, a leading growth equity firm founded in 2006 in affiliation with Susquehanna International Group. Ben and Josh focus primarily on direct private company investments in the software space. We cover quite a bit of ground in this conversation, from the genesis of Susquehanna International Group, now a global financial powerhouse, and the entrepreneurial mindset that drives the organization, to the founding of the growth equity practice, and to the current dynamics at play in the growth equity market. Both Ben and Josh graduated from Yale University with a bachelor's degree in economics. We hope you enjoy the show. Ben and Josh, thanks so much for joining me today. I've been looking forward to this conversation. As mentioned, I first got to know Susquehanna probably several years ago when I met Scott. At that time, I was over at B of A Merrill Lynch, and the Susquehanna Growth Fund was in its earlier days, but certainly well on its way. But great to spend the time with you here. Maybe what we could do for our audience is start off with a little bit of background, on the firm. It might even be helpful to give, to the extent you can, give a little bit of background to the overall Susquehanna, just to give people some context.
First of all, thank you for inviting us, RJ. We really appreciate it. We're excited to talk with you. This is Josh. So Susquehanna International Group is a really fascinating story. It's a bootstrap business here in Bala Cynwyd, just outside of Philadelphia. It's a company that's been grown over 30 plus years now. Unlike many of its peers in the financial services world, is still owned entirely by its original founders, who started the business out of college up in SUNY Binghamton. What they saw was they were really smart math probability guys, and they found interesting ways to apply their skill sets. They started out in the world of poker and horse betting, et cetera, and I guess maybe their parents weren't happy enough with what they were doing, so they had to transition, figure a way to apply those same skills to something more professional. What they found was in the financial services markets worked very similarly to the other games they were playing with poker, where you're making decisions with limited information and you're playing the odds. That's what they realized they could apply that to the financial services world, and they started making markets, so matching buyers and sellers of derivatives. Back then it was manual. It was a manual business 30 plus years ago, and they realized that as spreads would compress over time, they needed to do more in volume, and they realized that technology was going to be the driver of their business. And they were one of the successful firms able to invest. I mean, they invested a lot of money, a lot of people, a lot of time and effort into technology. And what it did for them is it transformed their business. They became a huge winner in that market. And as the spreads compressed, they made it up in volume. They become a huge company, 2,500 people, and very, very successful entrepreneurs. So why is that relevant? It's relevant to us because, number one, Susquehanna Growth Equity, we invest their money. So we don't fundraise. That has a lot of trickle down effects. It affects everything from how we spend our time, the pressures on our entrepreneurs, the types of deals we can do. And it's really a defining characteristic for us. Not only that, we're backed by founders, which is unusual in this world. So it really permeates the culture. It kind of has a lot of effects on us. And it's been a great partnership over the last 13 years now. That we've been working with them. And it's really one of our main differentiating factors is our relationship with SIG. Incredible partners, very supportive. And we've essentially taken the same thesis of investing in technology into these markets that were back then less tech driven. We're applying that same model across a number of different verticals today through a dedicated growth equity investment strategy.
I'll just build on that a little bit. I think what that means is, the founders of Susquehanna are still very engaged in their business, and they've built a category leader in what's kind of been a market characterized by very long-term sustained growth. I think that's really what we're looking for in our businesses, is kind of finding companies with strong and in the vast majority of cases, founder-led teams and in markets that you can unlock long-term growth. And we are built to have that kind of patience. We're not investing out of a fund where we have retirees, pensioners, and others that are investing in us. So we are money on money oriented as opposed to IRR oriented as a firm, and we are geared to have the patience to be able to ride market in what we believe are going to be very long-term penetration stories.
Just fascinating how the founders of Susquehanna International Group decided to get into growth equity investing. I guess when your organization is throwing off a substantial amount of cash, you can decide how to allocate that capital. You can allocate it back into your business. You can obviously take it personally and decide how you want to manage that money, or you could do something like set up a private equity operation within or tangential to your existing business. Curious more into the thought process of the founders, if there's more color to it.
Yeah, it's a great question. One of the things we talk a lot about within Susquehanna is the way that the founders think. They actually hire a lot of people out of school, and they know that people have great ideas. It's not always the people who have the longest tenure there. And so what they've gotten really good at doing is giving people within the organization an opportunity to essentially be an entrepreneur, to try a new investment strategy, to try a new type of trade. And they give them the capital to do so because they understand risk and they understand how to take risk. What happens is, the ones that are successful, they're almost like seed funding these groups within Susquehanna. And if they're successful, then they give them more money and they grow and they hire people. And if they're unsuccessful, then they go, it didn't work out. So they've been doing this for a long time within their core business, and some of those groups have grown into the largest, what they call them, pods within Susquehanna. And they've also done this with different investment strategies like ours. We also they have groups that invest in China. They have groups that do debt versus equity. One of the things I think they really figured out is let people who know their domain, their strategy, focus on that versus, a lot of family offices kind of get tied up where they have the same investors doing multiple strategies. All we do is invest in growth stage technology, software and data companies. That's all we do. So it kind of helps keep the lanes clear.
And to your point, RJ, this is Ben here. It is very entrepreneurial, right? These are first generation entrepreneurs, and I think that if we had a CIO and hired the CIO from other large asset managers, they'd probably think about the world in a different way. But I think it's I think it's a matter of finding great strategies, finding great businesses, and letting them run. But can't speak for the overall kind of grand mastery behind the asset allocation, but it's I think it's very, very true to an entrepreneurial vision here.
Well, I think this is a good lead in to how maybe you found your way, each of you found your way to Susquehanna, or maybe they found you. If we could talk about your personal backgrounds, what you focus on within the fund.
Yeah, Ben Weinberg, been to Susquehanna now for the past 5 years. Started my career, actually, have the misfortune of having graduated from undergrad and business school kind of headlong into recession. So undergrad in 2000, went to Wall Street in time to see a lot of carnage there. Mm-hmm. I was at Salomon Brothers, which became Citigroup very quickly. I was there in their Latin America franchise and later in their TMT franchise before going to business school in 2006. And then graduated there in 2008, headlong into, I started my job at Element Partners a month before they're closing their $600 million fund, and 3 weeks before the Lehman Brothers. So headlong into kind of the second great calamity of the 21st century. So
great timing.
It's great timing, and it certainly impacts how you look at the world. Element Partners, my first time on the buy side. It's a technology-oriented fund, actually. Focused more on industrial end markets, and that frames kind of how I look at the world. When I went from Element Partners and joined here in 13-14, I brought a focus on vertical markets, but vertical markets with a view was kind of more generally oriented towards what I call slow adopting or highly fragmented markets, and looking at the adoption of new technologies in these segments. So whether that's trucking, supply chain, kind of deep back office inside the enterprise, made investments in a company called Order My Gear, which brings technology and kind of the Shopify generation to mom and pop decorators and embroiderers. So finding nooks and crannies and sizable nooks and crannies where technology has not been adopted and can find accelerated adoption, where you have the right kind of simple and low friction solution set, and that's a concept that we've been able to replicate across a number of markets, taking that within kind of vertical software as well as horizontally across, financial, HR, and then other horizontal models, areas where that same kind of formula, that same formula is present.
Grew up in Pittsburgh. I wanted to be a doctor when I grew up, and I think my parents were really excited about that. I think they were actually pretty disappointed when I went to finance. Can't blame them. I think that changed when they saw my first paycheck. But I actually, I got started out investing in real estate, so not technology, but started a fund investing in buying essentially rental properties, renting them out. Back in 2005, 2006, and that was actually whenever technology kind of started invading the prop tech space, and actually ended up being inspiration for one of the areas I spent a lot of my time. But I joined Susquehanna as an intern out of Yale, and that was in 2010, and I've been here ever since. So going from intern to analyst to associate to VP to director, and I've kind of seen the firm over many years, kind of the different shades, how it's kind of changed and grown, and so that's kind of been my background, was sort of starting out, in investing in real estate, seeing the opportunity for technology, and kind of come into, I spent a lot of time in prop tech, as well as HR tech, a couple other areas, but I think it's kind of interesting to have that background, investing in that asset class without the technology background, sort of an inspiration for going into this world.
From both of you, it would be great to hear your thoughts on how you think, your firm has been able to succeed in a really competitive environment.
It really goes back to our founder, Amir Goldman, who started the group 13 years ago. And, he developed an investment thesis with, a couple of different bullet points. And what's really interesting is we actually went back and revisited it, as recently as a few months ago. And, maybe one or two things have changed here over the years, but for the most part, the original thesis stands pretty true. I mean, we look at, capital efficient, recurring revenue businesses with, defensible models and good retention. And I think that one of the big differentiation points for us is the way that we are set up, because number one, you can be a really good picker of companies. Like, we like to think that we're choosing entrepreneurs to back, and in some ways we are. But you also have to remember, like, the entrepreneurs are really choosing us. Mm-hmm. And we think that's where we kind of have an edge because of the way we're structured. Because of the types of entrepreneurs that choose us are the ones that don't want to be tied to a specific timeline. They haven't necessarily raised gobs and gobs of capital. They appreciate the flexibility, and to be honest, a lot of the entrepreneurs we're backing have shunned traditional growth equity because of all the strings that are attached. So I don't know, if I had to attribute it to one thing, I would say that there's a certain class of entrepreneurs who think a little differently, who have been choosing us, and we think that they've outperformed.
We are selling commodities. like it's the most commoditized thing that
money.
It's just capital. It's a question of who can bring it on the best terms. But even so, I think founders today in the growth equity world, especially when you're pitching the deals that we're pitching, which are minority deals, it's not only bringing capital on the best terms, but also the person who you're going to sit across the table from for an indefinite period of time. Are they going to let you do the things you want to do? Are they going to what kind of pressures are they going to place on you? And I think that what we bring is, I think, just a pretty different culture, right? And I've been in a traditional LP-based private equity model, and this one here. One of my mentors always said that private equity firms aren't firms; they're confederacies. It's a confederation of individual partners doing what they want to do, and they get into a room once a week and duke it out, and the strongest person ultimately gets what they want. And I think that's a pretty dysfunction view of the world. but I think that, I wouldn't be repeating it if I didn't think there was more than a grain of truth to it. And I think that you need to have kind of real binding culture, strength, tradition to kind of bring a firm together. And I think in many ways having the success of Susquehanna to look to, and kind of founder-led success compounding after 30 years, and then now for us in over 50 companies and still being 85+% founder-led. We kind of know what we're looking for, we know what we're not looking for, and I think that allows us to differentiate for like Josh said, the founders who are looking for a partner in their mold. It's not going to fit for everyone, but we believe there's enough out there to keep us busy.
How much rests on that entrepreneur or founder when you're assessing the company?
It's not so much the founder personally. Like when you get into a room, you're going to have a reaction to them one way or the other. But I think it's more the fingerprints of the decisions that founder has made, how they've built their business, how they funded their business, the types of people they brought in, and the strategic decisions they've made. And I think those ultimately are where the rubber meets the road. And I do think, much like any business out there, any investment firm, we have our heat map of what makes a solid investment. And I think that it's that history of decision making, finding founders who are going to be capital efficient, who are going to be aggressive when the time is called for, to be humble. And I think that, so I think you've got those kind of broad financial metrics of a business that are indicative of good decision making, strong market opportunity. But I think getting in the room, you have the interpersonal dynamics, and finding somebody who's very humble and who's able to reason through the successes and the challenges they've had. And also be realistic and optimistic about what's before them, what's before the business. And at the end of the day, we're all optimists, and we all think we're great. But greatness doesn't allow you to build buildings. It's great teams, and I think that it's those kind of soft skills we're looking for when we're in the room. But I think they're both external and internal kind of triangulation steps that you got to getting there as you form a view.
I mean, you ask an interesting question. I'm thinking through our portfolio. I mean, there are obviously entrepreneurs or founders we think, and we're just like, wow, they just really fit with the way we think about the world, and the people we probably follow to the end of the world, like the Colin Day from iSims and Ken Lin from Credit Karma. I mean, they're entrepreneurs where we spend time with them, and it does feel like we know. And we do the work around the business and what they're building, but the entrepreneurs are really strong. Yes, another interesting question, which was, are there times when it's not a fit? I think that's true. Yeah, I mean, I think you walk into a room and pretty quickly it's not going to be a fit. So, but I think that's always the case, and right. I'm sure vice versa. I'm sure that sometimes we walk in, we're not the right people, but I mean, you hear the cliche all the time. It's a marriage, right? Like we're going to be the same. Hopefully rowing in the same boat in the same direction for many years. So that fit does matter.
Got it. And then, maybe switching gears a little bit, taking a more macro view of the growth equity universe, it seems like, growth equity has been the flavor of the day going on a number of years now. You see some of the big private equity firms, developing their own growth equity arm. And then you get spin outs, guys that have been with the big firms. It seems like almost every other week I hear of a new, 2-3 person team that's spun out and has or is raising their own fund. Just got one yesterday over text. So how do you think about this growth equity universe? Is it big enough where you can have a ton of various firms out there competing for deals, or is it, do we have enough? Are there just simply so many companies out there that it doesn't matter? You can keep having, new firms pop up every week, and they'll still be able to find great companies. What's your view overall?
Yeah, I wish I could translate it into a total carrying capacity of kind of AUM that can sustainably be deployed into this sector. But I think there's a share shifting happening out there. You've got kind of enormous amounts of enormous kind of enterprise value that's encrusted in traditional services companies that is being transferred into the software world. And for every dollar, maybe 50 cents of those dollars are going to be of that enterprise value be transferred into the software world. And I think the collective software market cap, and I'm talking outside of the Facebook, Amazon, Google, because I view that as those aren't services companies, those are kind of retailers. But I'm talking more about the word processing body shop that's across the street from me in the building on City Line Avenue here in Philadelphia. And there are thousands of those firms in the United States and around the world. And there's a huge amount of enterprise value that's going to be created in making those firms a lot more efficient in what they do, and really just changing the structures of how those firms execute what they do on a day-to-day basis. I think what we see all the time, right? Like if we take the deals that we were looking at in 2012 and the deals we're looking at today, at the end of the day, the companies look very similar, right? They're $30 million revenue businesses, $20, $30 million revenue businesses that in 2012 were looking for a 15% liquidity round and looking for a little bit of primary capital so they can go take the next turn. And today that same business is looking for a 75% recapitalization. I think that the private equity universe has gotten much more comfortable investing in deeming kind of quote maturity at a much lower stage than they were a number of years ago. And part of that's born of the fact they have a lot more money burning a hole in their pockets, and part of it's a realization that a $20 million SaaS business is not as fragile as a $20 million service business that had that had 8 customers, all kinds of uncertainties in the market, volatile labor costs, and so on. So I think maturity happens at a very different point than it used to. So there's a lot of enterprise value that's being created in technology businesses, and entrepreneurs that say, boy, I'm at $40 million of value, I'm good. I don't need to have $200 million of value in my pocket. And I think it's appropriate in many ways from a risk sharing perspective for that value to be held in institutional hands as opposed to individual hands. And I think we've seen a lot of it, right? I mean, you probably have a clear sense of the AUM created or invested behind growth strategies. It's been staggering. Yeah. But I'm not convinced that we're wildly oversaturated.
Yeah, software is taking share. The deals are bigger. There's lots of dollars up for grabs. The other dynamic here is companies are staying private longer. Yeah. And a lot of the equity value accretion is happening in the private markets, not in the public markets. And you can debate over why it's happening, whether there's overregulation or whatever happened. But there are half the number of public companies than there were 15 years ago. So now you have all these companies that are taking share from traditional industries, moving it towards a software business model, and they're able to stay private and get access to capital as they grow. Instead of going public when they're 30 million, they stay private until they're 300 million, yeah, 500 million of revenue. All that value is being created, and it's accruing to the investors and the owners and the management team members rather than the public markets. So I think that's opened up a lot of space as well.
Yeah. It's right. I think about your business, and I'm just kind of. Mm-hmm. I remember when I first heard of GrowCap, right? And it was like, wow, this is a media outlet focused on the growth asset class. Like that seems very narrow. And now you serve an enormous asset class, and yeah, you're a very meaningful voice for something that's got a huge number of LPs, investors, and CEOs attracted to it. So I think it's kind of an incredible. It's been an incredible evolution, kind of, much like anything, kind of in hindsight, it makes a lot of sense, but all hard to predict from 2013.
Certainly this whole category, and I know, Cambridge Associates puts out their piece on, the three different kind of segments of, buyouts, venture, and growth equity. And growth equities tended to, I don't know what the latest is, but they've tended to, outperform, not by a huge amount, but it's an asset class that's been both growing in AUM as well as improving in performance and returns. Maybe we could close out with what each of you are most focused on, most interested in, and are, I guess, most excited about, in the future.
I mentioned this earlier. I think real estate is one of the verticals I'm spending a lot of time in. Investments in boomtown build out, one that we're going to be announcing here in a couple of weeks. And I think, real estate, everyone kind of points and says, yeah, obviously it's the largest asset class in the world. It's worth more than all the stocks and bonds combined. 3.5 trillion contributed to the U.S. GDP, in a year. It's a huge market, and it's attracting investors too. I mean, I think there's $10 billion last year invested in prop tech companies globally, half of that in the U.S. So it's an area that's really attracts a lot of people. There's obvious reasons why it's a huge market, but it's one of the last to adopt technology. Software is taking market share from other markets like this. There's no exception here in real estate. And when you have these types of numbers, these size of markets, like that's a really exciting place to be. So we're spending a lot of time there. The world is changing for everyone in real estate, project management, facilities management, workflow tools, marketplace and listings, like just across the board, marketing technology, access to data and analytics. It's transforming life for the whole life cycle, from owners to brokers to tenants to contractors. Like, it's such an exciting place to be. We're interested in digitizing workflows and increasing transparency in that world. And when you move the needle a little bit on markets that large, it ends up being a pretty big movement. So that's where I'm spending a lot of my time. Ben?
And I think, like I said earlier, for me, vertical software is an area of great focus, and looking at that, especially with the extension of kind of where vertical market software goes. I think we've gone from the Salesforce IPO in 2003, and we're taking over huge segments of broad corporate workflows. The world of new software innovation has gotten more and more finely sliced. I still think that within those fine slices, we've got enormous opportunities for not just software, but payment and supply chain applications. I think that finding these network businesses that are able to integrate elements of supply chain, elements of financial technology, and kind of core functional software, there continue to be really interesting opportunities and interesting unexpected opportunities in those areas. And then I'd say the second place, kind of from outside of a deal perspective, I think that I'm spending time focusing is around this question of as we SGE scale. I think we try to think of ourselves as a firm. We articulate values and an operating mindset is kind of distinct, I think, from many other investors out there. As we get bigger, and we have gotten bigger, going from investing $100 to $150 million a handful of years ago to now investing $200 to $300+ million a year. There's a question of how we build and scale in a way that's culturally consistent for us, making sure that we continue to enable founders and kind of build around our teams and continue to get that message out of being what we it's a high aspiration, but the Berkshire Hathaway of this world, finding great franchise, continuing to build those franchises, being able to create a lot of value for ourselves and our partners over very long periods of time in franchise leading businesses.
Yeah, well, certainly, some of the points of differentiation that you both articulated, throughout this conversation, I think will really be taken well by the entrepreneurs and CEOs in our audience. Certainly, the flexibility in how you invest and not being confined to the typical constraints of a PE firm or a formalized fund. Really appreciate the time, Ben and Josh. Look forward to chatting some more.
Likewise. Thank you for everything you do, and thanks for having us today. Appreciate it.
Thanks very much.